Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
G'day, welcome to the Australian Property Podcast. I'm Pete Wargent and I'm back online with Chris Bates from the Flint Group. How's it going, Chris?
Doing well, Pete. Welcome back to Australia. It sounds like a pretty good trip. We just got back from a very short trip in comparison, but a bit too long for us, to be honest. Went up to Southwest Rocks for the long weekend, which it looks good on paper when we're looking at it. 5-hour drive north, and couldn't be that hard. But with 2 young kids, we were thinking, hang on a sec, we've got a bit too far here. But it's very beautiful up that part of the world. We haven't been there before. So, how was your trip and how's the flight back?
Yeah, pretty good, thanks. Yeah, we got a bit of a delay flying back from Los Angeles, but yeah, we had a cracking trip over to the US. That was, really interesting, actually. You always, I suppose, as an international traveller, you're always sort of weighing up what's different versus Australia and what's the same. I think there's a lot of parallels, though. Clearly, for all of the news articles about inflation being under control, I think the lived experience in a modern parlance of day-to-day people, everyone can see the cost of living has gone rocketing up. Everything you do is $100 now. And I think with the Aussie dollar as well being lower than it was, you really feel it as an international traveller. So, but yeah, for that all having been said, the economy in the US seems to be going pretty well. So yeah, I've been in Boston and Massachusetts for a wedding, and then I had a week in LA down at Venice Beach. It's all pretty interesting, but also it's good to be back on the Sunshine Coast and Noosa as well. Pretty lucky in Australia to live in a relatively problem-free part of the world. But, I guess the cost of living issue is global at the moment.
And how big's the election playing out over there? It's obviously the world's watching, but what's the takeover in the States? Depends where you are, I guess.
It definitely depends. Yeah, it depends where you go. I mean, there's people have got their signboards out. Election mood is sort of big time. It's very divisive, I guess, at the moment. And, I think the general mood in the US is a bit of it fractured. But I think the other thing is, though, it's just it's not an economy to bet against. You go to, now, bearing in mind I've been to some of the tourism hotspots, but if you have a day at Universal Studios, you're getting no change out of $2,000 for a day out there these days as a family.
Wow.
It couldn't be busier. It could not be, they could not fit more people through the door. So, yes, obviously the other end of the scale is a lot of people falling through the cracks as well. So, so it's a very different kind of economic model in some ways, but there's clearly a lot of cash around despite everything. And, it's only a month out now until the election. And, I think people are just starting to feel some of the benefits from lower interest rates. But clearly, the cost of living is really the big one. And, you can't go anywhere without noticing the cost of living in the US now.
Yeah, I guess since you've been away just the last couple of weeks, the election news here keeps starting to pick up some speed as well. Let's crack on. Obviously, every Sunday at 7 a.m. we do these 3 stories of the week. What are we going to chat about today, Pete?
Yeah, so, there's been a couple of other sort of interesting things before we get onto the 3 stories. So there's, I suppose, the few things that sort of jumped out. One is, as you mentioned, yes, Aussie election coming up. I think CBRE put out its apartment vacancies report and outlook, and they're basically saying we've got a decade-long rental crisis right the way through to the next 5 years, which is their projection period, and they're expecting rents to grow 25% over the next 5 years. So apart from anything else, the supply shortfall, vacancy rates are projected to drop. So I think that does feed back into the election point that you made, because housing is going to be front and centre for this election again. Green Party is trying to push for various reforms. Labour wants to take the Help to Buy policy to the election. Coalition's thinking more along the lines of super for housing. So it's all shaping up to an election fairly soon in Australia, with housing policy right at the front of the queue, I suppose. Yeah, the other thing that's just been interesting before we crack on with the 3 stories, just in the past week, there's been rising tensions in the Middle East. Oil prices have jumped to $80 a barrel. And I guess, a bit of a pushback against the narrative of rapidly falling interest rates over the next 18 months. So I think we'll still get some relief, but it might not be. Yeah, well, who knows? There's a lot that could happen with a change of, government and Middle East tensions erupting again, and so there's a lot of uncertainty around the world. And Australia, we've got our own uncertainties at home, obviously, because of the election.
Yeah, do you think that it could be if you go back to the Russia-Ukraine situation, I mean, that was definitely one of the issues that caused inflation to rocket up. I mean, do you see something like that perhaps here, Pete, where, it sort of gets a lot more tense and, a full-on war sort of breaks out? Do you see that happening? And what would that impact be on inflation?
Well, that's right. So, let's go on with the three top stories of the week then, because this was really was largely the first story. So, just from a global view, yes, Middle East tensions erupting, oil prices are up 10% in a week. Bond yields have shifted, and that includes in Australia. So, even in a week, the 3-year bond yield is up from about 3.5% to 3.75%, and now. If you think about the interest rate story, everyone was saying the Fed Reserve has to cut 50 basis points again. And the next meeting, now markets are thinking, well, okay, maybe 25. And all the way along the curve, there's just fewer rate cuts priced in. So, yeah, look, we mentioned already the consumer economy is still romping along in the US, but there's just a lot of uncertainty. And I suppose, the big question for Australia is it looks like inflation in real time is about back into the target band. But what happens if the fuel prices start going up again? And what happens if those interest rate cuts start getting fed into expectations? Because even though the Reserve Bank hasn't moved, I expect as a mortgage broker, you're starting to see fixed mortgage rates from 5.5% and below. And people are starting to almost get ahead of the curve and starting to price in, I suppose, some of these expected easing over the next 18 months. So, what are you seeing in terms of demand at your end? Are you getting sort of a change of viewpoint from people who are coming to borrow?
Yeah, I'm trying to remember back. It was when the yield basically completely flipped, 4-6 weeks ago, and that absolutely, higher for longer rates. Actually, no, rates cuts are coming. We absolutely saw a big jump in demand and people coming to us. A lot of old buyers, old upgraders, old investors, even old first-home buyers that have maybe been in and out or thought they wanted to transact in the last few years, but just put it on hold. And so they've come back. But, it's already sort of October. I do think if there's a little bit more uncertainty in the market, all that'll do is dry up listings, right? People will go, maybe I shouldn't do that upgrade, so I won't list now because I want to see what happens over the next few months. So uncertainty, I think it absolutely affects demand, but I'd say it affects listings more in an undersupplied market. That's just going to make it tighter, I would say. People sell their properties when they've got more certainty. If they think, hang on a sec, maybe we're not, the inflation genie's not back in the bottle and rates are going to stay high for longer. Maybe I don't want to do this upgrade or buy an investment property. So, I think, I don't know. That would be my take is Pete, that, but I do think there's a lot of people ready to go in the market, but I think there's a 2-speed market. I think people are saying, hang on a sec, I know I want to transact, but I know I've got to live in this thing. I know I need a home office. I know I need this type of property. I don't want these to make these compromises because it's not FOMO in the market. So I'm going to be really selective. And I think when you're seeing, look at option results is, clearance rates are falling, but that doesn't mean the ones that do sell, some are rocketing up and, getting big prices. And so, that's what I would say that the take on the market, right, Peter? It's kind of, cruising into Christmas, at a slow pace. It isn't like full speed ahead. And some properties are transacting and buyers are really picky, but it's not, rocketing up like it was a, 2019 or a 2021.
It feels that way. It's interesting you mentioned there the 2-speed market, because I guess the policy makers are hopeful of gliding the economy into a soft landing, and it looks like they're making the right progress. So the Melbourne Institute released their latest inflation gauge this week, 0.1% for the month, and that comes after a fall of 0.1% last month, and only 2.6% inflation over the year. The core inflation figures over the past 3 months, the inflationary pressures seem to have evaporated. So it seems to be going really well. But as you mentioned, there must be a whole heap of borrowers out there who borrowed when interest rates were very close to zero. and they've seen this massive increase in mortgage rates. So I expect there's a lot of people out there under mortgage stress, or at least contemplating whether or not to sell. I know most of people on your books you mentioned previously are well ahead on their mortgage repayments, but do you have any advice, or what advice do you normally give to people who are facing mortgage stress? Because there must be a lot of them out there just purely based on the changes in mortgage rates over the past couple of years.
It's interesting, because we had a lot of clients fix 4 years ago, and they're coming off sub 2% interest rates, and they fixed 80-90% of their loans, right? Because at that point, it was such a good bet. And, these were new buyers. So these were buying, 2020, 2021. And so we've got a lot of clients who are still on sub 2% fixed rates, right? And, we get the emails, in December, I'm coming off. And a lot of them have actually been putting, money aside, right? Because they know they've had such a sure bet. They can see it. They're not oblivious because they know that there's an end date to it. And so I do think the ones who got really caught out, the ones who hadn't fixed and had bigger mortgages. But, a lot of the people who got the biggest mortgages did fix, right? Because they leveraged up at that point. And so, we haven't really seen that mortgage stress going on. It absolutely is happening. I think the people who also had the biggest mortgage were the ones who were the most confident financially as well. So they were confident in their short-term financial prospects, hence why they leveraged up and really stretched their borrowing capacity. We have seen some investors bail because, that makes sense to cash in one or two properties so they can restock their cash buffer. But obviously what you want to do is try to buy as much time as you can. And if you have to speak to the bank, speak to them before they want to speak to you, would be my bet, and not get missed payments on your file. So, and really talk to them about it. They're going to want to work with you, and you, rather than you just smashing your credit file by putting your head in the sand, I think that's the wrong move. And speak to your broker. They can also give you some advice and see if there's any chance of refinancing you, because you might think there's no chance because borrowing capacity's fallen 30%, but you've got non-banks, there's even private lenders, there's all sorts of options that you might want to consider.
Good advice. Yeah, it does feel like banks are much more proactive these days in working with stressed borrowers than they used to be. And it seems there's not really very much appetite for people going into arrears and then defaults and then forced sales and all of that kind of thing. I think banks would much rather work with stressed borrowers. And there is potentially some light at the end of the tunnel next year as interest rates fall. So good advice there from Chris. All right, let's crack on with the second story then. Is the property market softening into Christmas? So it's pretty interesting. There's a lot of articles out there about lower auction clearance rates and demand sort of tailing off. But then on the other side of the coin, the ABS released the latest lending finance figures. Now, these always lag a little bit, and they're the figures for August, but lending was up 1% in August. Investor lending, this is the other side of the coin, which you referred to, Chris. Investor lending was up 34% over the year, and it's back to near record levels now. At the same time, building approvals are still weak. There's a lot of talk about rezoning to allow for new apartments, but nobody really wants to build at the moment. So it's not really stacking up for a lot of developers. But there's definitely been some softer auction clearance rates, largely in Melbourne and to some extent in Sydney. I guess, I've been overseas, but I guess the grand final weekends for the AFL and the NRL kind of impact each of those cities on different weekends. But what are you seeing back in Oz, Chris? Are people is the market cooling off? Is there a bit more, people are a bit more intrepid, or is this just a temporary thing? What do you reckon?
It's funny. I thought you were going to mention the AFL Grand Final. Congratulations on that. What a win that was for Brisbane. I know you're a big fan. Absolutely. I think that there was a little bit more stock on the market as well. And I think this is where all the agents basically said to all their sellers, look, get in front of the spring market. You want to get it listed prior to the grand finals and the school holidays. And and they basically sucked up all their listings and pushed them early in the market, which gave buyers a bit more choice, which then led to lower auction clearance rates. But I'd be surprised whether the agents have still got that much stock coming on over the next couple of months, right? And I think that sort of belief that more and more is just going to come on, because if it doesn't come on in the next 2 weeks, you don't really want to be listing in this market where you are seeing not as strong auction clearance rates. And Still a little bit uncertainty around when interest rates are going. You don't want to be listing in November, right, Pete? Like that would have to be your last option rather than potentially just holding it back to go to February. Is that sort of what you see when agents talk to sellers, is that, after you get to like sort of early November, it's probably not a great time to list?
Not really. I mean, if you want to have a full auction campaign that goes for 4 or 6 weeks, you're leaving it very late in the piece because by December, they've already moved on. They're starting to think about the silly season, going away for the summer break. There's fewer auctions as you go in towards Christmas. So, I think if you go to generally try and get the best deal on a sale, and if you're going to go through a full promotion campaign, well, it's getting quite late already. It's already the second week of October. And bearing in mind, not much happens in December. We're getting towards the end of the time, I suppose, for people listing. Now, some people might try and sell off market or sell quickly or something like that, but that's a different story. There's one other thing that sort of popped up, related news, I suppose, on the lending piece. And you're right. Actually, I watched the Lions game in Boston. There's not many AFL fans in Massachusetts, but I did find one or two knocking around the place. But the 3% lending assessment buffer has been back in the news just a little bit this week. And Baron Joey's Jonathan Mott, who I think you know, he sort of did some research in a submission to the government saying lower income earners are now being shut out of the market. So more and more borrowers as a share of the pie now have a household income of above 200,000, which is great for them. But it's been very difficult for lower income earners to get into the market. Now, first home buyer numbers have held up okay, largely because of the bank of mum and dad. But it's getting quite difficult now for people on a modest income to even get a loan. Now, it was suggested by Dr. Alex Joyner of IFM Investors and various others that maybe if there's a change to the buffer, it might be for first-home buyers only. And I also noticed the coalition is talking about taking a potential reform of regulation to the election to try and take some of the power away from regulators to sort of have these macro-prudential rules in place. Because at the moment, it's pretty difficult. If you want to borrow, you're being stress tested at maybe 9.5%, a mortgage rate you'll probably never pay. And it's not helping the supply of new apartments or new properties. So, do you think there'll be any change there? And do you factor that in when borrowers come to you? Do you factor in a potential change in borrowing capacity, or you just don't know about the future?
Yeah, it's an interesting one, right? Around making changes just for one part of the market, right? And it sort of makes sense if you think about it. Like a lot of first-home buyers, they're at the start of their careers, their incomes are going to go up. They have also got on the counter side of that, though, usually a lot of first-home buyers, because they're leaving it a bit later to enter the market, are also colliding when they're getting married and they've got little kids on the way, right? And so their incomes, actually, they go for a bit of a danger zone compared to, an upgrader who maybe the kids are a bit older and going to school and, they haven't got this, both parents are working full time, right? And so on some sense, it makes sense, give first-home buyers the ability to leverage up a bit more because they're at the start of their careers. And the other side, you say, hang on a sec, they've also get into their danger zone with their family income. But, the issue we think like that is to go, okay, well, let's give first-home buyers a bit more money to spend. And the moment they're spending every single cent, right? Like, so what is the maximum borrowing capacity? That's exactly what they want to know. And this is actually playing into the broker market even more so. CBA will hate this because borrowers are coming to us and say, I need to get the most I can borrow because my current option I had isn't enough, right? And so what we do is we can then compare the market and look exactly who in the market's going to give them more money. Now, they're quite close, but that extra 50 grand might mean a lot to someone. That might be the difference between able to buy something they really love versus something that's just okay. And so if you give first-home buyers more money in this market, they'll go and spend it. And unfortunately, first-home buyers buy where other first-home buyers are buying. So all you're really going to do is just give more budget to people who are all buying in the same area, and they're all going to go and spend it. And so they're not going to actually get any properties any cheaper. They're just going to, everyone in the auction's going to have another 5 or 10%. And prices are going to quickly adjust to that. So I don't know. I think you just got to be careful when you make tweaks like that. It sounds like you're trying to help, but whether you're actually going to really help, I don't know. I do think there's going to be a lot of pressure on doing something for first home buyers. Hence why I think the Liberals getting access to super is going to go down quite well. I think once they start to put a lot of noise around that, it's going to play well with the story right now that intergenerational wealth. I haven't got access to deposit because I haven't got wealth in the family, and so the only way I can do it is accessing my super. And people are got that real desire for security right now, and so they're going to probably vote with their feet to say that's actually in my interest, even though I don't believe in other policies of them. Let's say I'm going to go for that because it's in self-interest. I do think it's a policy for right now, particularly if what the Labor are saying is we're going to make cuts to negative gearing and changes to CGT. That's not as tangible as, say, getting access to your super for first-home buyers.
Yeah, it's a good point. I mean, obviously, we have had policies for certain parts of the market before. So we had changes for interest-only mortgages with the 1% differential. Then we had the clampdown specifically on investor lending. So it's possible who knows? I mean, I don't have any special intel with what's going on at APRA, but clearly there's pressure being applied, and not just from political parties, but also from banks. Previously, one of the bank CEOs said that lending is becoming the purview of the wealthy. So, yeah, I think that's something that will get a lot of airtime in the lead up to the next election. Just before we rip onto the third story, Fin Review had a piece out this week, 3 reasons why the global housing super cycle is just getting going, which obviously gets the usual range of comments and feedback. But they did make a good point. I suppose the first thing is falling interest rates. Second thing is demography. So the world's richest countries are attracting a lot of immigration. So Canada, Germany, Australia, New Zealand, US, and so on. And housing supply just isn't keeping up. And another point they made, which is the one I wanted to just double click on, a phrase that I used to ridicule people for using, and I'm doing it myself, is how the working from home phenomenon, although it has changed theoretically the way in which people can work, so more people can work remotely, but cities are still creating the bulk of the jobs. And although, yes, some people can work fully remote, a lot of people are in the office 3 or 4 days a week anyway. And it's just been torturous trying to get infrastructure across the line. I know Sydney successfully did manage with the new metro line, but it's compared to the speed of at which these cities are growing, the infrastructure never really seems to keep up. And I saw in the Reserve Bank's Financial Stability Review, they showed how commercial asset values in Australia are down about 15% from the peak, and those figures are way out of date. But if you look at US, Hong Kong, Europe, commercial values are down about 25%. I think there's a massive push on now to get people back into the office. I think it started quietly, but now a lot of these businesses are really starting to feel the pain of not just lower office values, but underutilized space, productivity challenges. Shareholders are getting grouchy about margins. And just in the past 2 days, we've seen Flight Centre have gone back to the office full-time with no exceptions, unless you've got a good excuse. And then also Dell was another one. So some big international businesses as well, really trying to push people back into the office. So I think the working from home phenomenon is definitely benefiting in areas like Southeast Queensland, where I am. But it does also seem that the cities are kind of reasserting themselves and dragging people back into the office a bit.
Yeah, absolutely. I read that article around the super cycle, and yeah, I mean, immigration's obviously a big one. Underbuilding, the problems we have with building infrastructure, and and how tied we are with knowledge workers. That shift to knowledge work and tied to the office, and that was obviously the story coming into COVID that we were betting on. To be honest, we were betting on that people would want to be close to the city because that's where the greatest work prospects are, and they'd want to value time because they want to spend time with their family, and so they don't want to be commuting for a long time, and so they'd rather have a smaller place close to the city than a bigger place just a bit further away from the city. And COVID completely shifted that up. But I do think we're heading back in that other direction, right? And yes, some people can get good flexibility because of what they do and their position in the firm, but a lot of people, that isn't an option, or they don't want to do that because they know that it's maybe a short term is going to cause them some issues if there's any cutbacks and wage work prospects. So yeah, absolutely, we're seeing that as well, Pete, and it makes a lot of sense when you look at that, particularly for countries like Australia that has very high immigration and attracts some wealth around the world. When they come here, they want to live somewhere, and we're living in our houses longer and longer now just because there's limited options. I think the underbuilding, and I see this leads into our third story, Pete, the underbuilding of things that really suit families in our capital cities is really coming back to bite us. I think we prioritize just investor money over the last 2 decades, and encouraging investors to buy apartments, which was great, yeah, but then we built a lot of 1 beds, 2 beds, and studios. We completely underbuilt, things that really suit families, rather than really high densities, things with a lot of green space, buildings that are nice and quiet and private, and with lots of families in them. That's just not what we built, Pete.
Well, that's right. So this is the third and final story for the week. So neither Sweeney or the AFR, nobody's biting in these buyers' markets. So, yeah, as you said, it's the previous decade's cycle, I suppose, was largely driven by investor lending, particularly from international buyers in mainland China. And there was a massive boom in construction, and a lot of those markets are really underperforming. So Epping in Sydney, New South Wales, Beecroft, Chatswood, Olympic Park, where there's been some high-profile defects for some of those new apartments. But in Melbourne also, East Melbourne, Abbotsford, Kensington, Armadale. So, yeah, there's a few things going on there, isn't there? One is that people are paying top dollar for some pretty ordinary apartments in a lot of cases. And as you mentioned, a lot of them were very, very small. I mean, I sort of, out of interest, looked at some of them around Newstead in Brisbane, and some of them are like, 40 square metres, view over a car park, very dark. They were really built for investors, not so much built for people to live in. But now that's coming back to bite, and defects are a concern, definitely. And also just a lot of that stock just isn't suitable for owner-occupiers. So in Epping, the median unit value is down 18% from 2017, back down to 800,000. And listings are also above their average in that kind of market. So that's just one example in Sydney, but there's a fair few others. And of course, Olympic Park, where there's been apartment defects and quite high-profile stories in that regard. It's really put people off some of those micro units, and particularly some of that new stock, which is proven to be of less than stellar quality in a lot of cases.
Yeah, I think when all property goes up, it's very easy to find properties that haven't performed. You look at the CoreLogic Pain and Gain report, and look at apartment markets, particularly in Sydney over the last 5 to 7 years. But if you look at Brisbane and Melbourne, they've had a tough time down there. You're talking 10, 15 years where people have owned an investment that hasn't gone up in value, and there's been a negative cash flow for them. And then there's building defects, etc. So I think this is just more highlighting where things have actually gone wrong for people. I do think, though, there's this world collides where a lot of downsizers want to get out of houses, the cost to maintain, they need a bit more money in their super, but they want to downsize into something, and there's just nothing for them to downsize into. They don't really want to go from a 4-bed house to a 1-bed apartment or a 2-bed apartment. They want something a bit bigger. They want a 3-bed. They want a double car parking, and they want to be able to have their kids and grandkids around, right? And those apartments just don't exist. They just weren't in demand 10, 20 years ago because people bought houses. So they want them, but also family want them, because the families go, I can't afford the house, and I don't want a 1 or 2-bed apartment because I've got 2 kids. I want a 3-bed with 2. And so they're looking for those as well. And so I think this is when you read the CBRE report, they're sort of forecasting massive growth in the 3-beds, but nowhere near as much growth in the 2 and the 1-beds. And this goes back to what we were advising clients, 5, 10 years ago. Look, if you're going to go for an apartment, go for something that's scarce, pay that little bit of a premium for a 3-bed because if it will get you into the family market. And I think, a decade on, that's starting to sort of prove the case because there's just a real lack of supply.
Yeah, completely. I mean, I think one of the reasons you get the property market cycles is there's definitely a recency bias, and it can get very pro-cyclical. Markets are booming and people just think, well, shit, I better buy now because otherwise I'll be paying 10% more in 3 months' time. And then you get this kind of booms and busts. But it's the same on the other end of the cycle. And if people can see units in some of these suburbs where prices are down 10 to 20% over the past 7 or 8 years, then investors would say, yeah, sure, rents have gone up, but is it really that attractive, even if the rental yield's okay, if the capital growth is zero? We saw that in lots of parts of Brisbane for about a dozen years. There was just no change in prices in a lot of places. And then Eventually, the shortage got so acute that things just spiked 50% higher. But I'm just going to quote from the AFR article here. Sydney Olympic Park units have dropped 15% from their peak. Unit values in Granville, Maryland, Harris Park, Parramatta and Guildford in the western parts of the city are still lower by more than 10% with their record highs of 2017, while those in Regent's Park, North Ryde, Mascot and Cabramatta have slumped by about 9% during the same period. I think the question mark for me, Chris, is lots of talk about rezoning, lots of talk about maybe a government developer building, but I mean, if prices for a lot of units in those markets are down 10 to 20%, at a time when construction costs have lifted by maybe 50% over the past 4 years, cost of money is now expensive again comparative to what was the case. I mean, who's going to be building? I just think CBRE have highlighted this issue that over the next 5 years, we could see vacancy rates tumbling further. We've got high population growth. Building approvals are still very weak, and it's just not that much appetite for building at these price levels.
Yeah, it's going to be interesting to see how the lower rates affect things, like even under high rates, you'd have to say you'd be surprised with the amount of owner-occupier demand over the last few years. It makes sense that investors are entering the market because that's, the negative cash flows can be deducted. They're on top of their mortgage, let's say, they've got a smaller mortgage or that a lot of investors, I would say, are first-home buyers, right? And so they're buying, but they're just taking out investor loans or they're buying investor property somewhere else in the country. It's going to be interesting to see when interest rates do flip, borrowing capacities go up, how that really, does the market pivot, right? Do prices start to run? And does that then lead us to being able to actually build some of these apartments? And just to building costs subdue a little bit, like do we start to see building costs come back down a bit or do they stay really high? I don't know, Pete. It's going to be interesting to see. But this story of higher rates has surprised us how resilient the market's been in the face of very low capacity and higher rates. There's been a real handbrake on the market, but it doesn't appear that way when you look at the numbers, right? Like the growth is still there. What's your take?
I think, construction costs historically have never really come down. There's been periods where they've flattened out. We've still got, even now, relatively tight labour market, so that's keeping some kind of upward pressure on the cost to build that new supply. The other thing is we've got very strict energy requirements and livable housing standards now, and it all impacts the cost of new builds, and that's before you start to overlay all of the taxes and so on. I saw some research this week that was saying how if you look around southeast Queensland to build a new house now, you're looking at about $450K just for a basic low set house, and then you've got $500K for the land, and then you've got the cost of transacting. So it's $1 million. It's very, very difficult to bring the new supply on at affordable levels. And for apartments, it's often harder, I think, because you've got site remediation. It's difficult to find good locations unless you've been land banking for 20 years. So, I think, yes, you're right. Construction costs will probably level off and interest rates will probably come down. And rising prices usually get developers interested again. But at the moment, we're in a kind of a lull for building approvals. We've seen about 160,000 over the past year. So, CBRE forecasts apartment supply at about 50,000 per annum for the next 5 years. But we need something more like 90,000. So that supply shortage is not really being addressed. In fact, it's getting worse. So, it's a bit as you were in that regard. So, nevertheless, watch this space. So that's more or less everything I have for this week. Chris, what do you have planned for the weekend?
Yeah, I think you're right, Pete. For this, watch this space for the next, 4 weeks. It's just really seeing how does the market hold up. And from our point of view, it's us seeing how many people are starting to get ready for 2025. You'd be surprised, like, a lot of people do come to us in November, and January is actually usually quite a busy month for us. December, not so much. I do think a lot of people have got other priorities. And so it's going to be interesting to see how much of our clients start coming back over the next 2 to 4 weeks, coming into November and say, look, it's just getting ready because I know next year's the year for me. And, other than that, Pete, it's just head down, bum up again here. This is trying to get through obviously everything with the merge and we're still setting up our teams. We've got a big launch in a couple of weeks. So lots going on.
Pretty good. And it's daughter's birthday for me. So I've got to go and do the high ropes thing at Maroochydore. So if my arm's in a sling next week, or if I don't turn up, I'll probably plunged into the Sunshine Coast, Sunshine Plaza River or something. But other than that, pretty quiet and just ticking along. So if you need mortgage advice, Chris is your man. The Flint Group, easy to track him down. Link in the show notes. I'm Pete Wargent from Alan Wargent Property Buyers. And if you've got any questions on property buying or strategy advice, just give us a oi. And also don't forget the Rask community forum is now online. So chat forums there on property, shares, or anything else you're interested in business. Always good to connect on there as well. So that's it, I think, for this week. Thanks, Chris. I look forward to catching up next time.
Happy Sunday. Thanks for listening.
Cheers.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.